All right. Gentlemen, good morning. My name is Ian Lustard. I'm CEO of Australis Oil and Gas. We're a listed ASX company. We were formed 3 years ago, and the management and principals were from another company called Aurora. That company held assets in the Eagleford Shale, and management grew it from an enterprise value of around about $30 million in 2005 to $2.6 billion at the time of sale in mid-2014. Having been through the exploration, appraisal, development, and ultimately divestment of that particular asset, we felt that was a skill set that was worth retaining. And it was and ultimately from our side, we felt that it was worthwhile keeping the team together and looking to put that track record back to work. In themes consistent with what we were just hearing, as we were devising our strategy during the price fall that occurred subsequent to the sale of Aurora, we felt that rather than looking just to secure and purchase existing producing assets in the US and looking for a relatively linear return on our investment, if we were to secure oil in the ground and if we were to secure a future inventory of undeveloped locations, then we felt we could do that at a much more accretive price and generate greater shareholder return. But of course, there'd be little point in securing that inventory if we simply had to then develop it into a low oil price environment. We concur certainly with some of the points that are being made that there are drivers for an increase in oil price going forward, and therefore we wanted to retain control. We developed that acreage as and when the oil price recovers. In order to retain control, we had to be operator, and in US parlance, we had to make sure that we had a long lease life available to us, which gave us maximum flexibility. The company was private for almost 2 years. We sourced our initial opportunities. We listed in July of 2016. And in April of this year, we secured a large asset and went through an investment that met most of our corporate and strategic goals. As of today, Australis holds the largest acreage position within the core of the Tuscaloosa Marine Shale, the TMS for short. Within that production delineated core, there are geological characteristics that drive average oil well productivity that are comparable to any other US play, any other US unconventional play. Today, Australis is the largest producer within the TMS. We produce around about 1,600 barrels of oil a day. We have an NPV 10 associated with 5 million barrels of PDP of $95 million US. The acreage position has been assessed and has been allocated 107 million barrels of contingent resource. That resource is considered economic today, but consistent with our strategy of not wanting to develop into a lower oil price, it's designated contingent until we press the button. The position, we believe today, sits at around about 290 net locations that we have within our inventory. This is based on 250-acre spacing, and if we assume a future well performance, which I'll talk to in a minute, that's around about an 8% recovery factor of the in-place volume. These are very conservative figures. Around about 75% of the acreage that we hold is HBP'd. The contractual commitments have been met, and what's left is relatively long lease life. So we have flexibility, which was an important element of our underlying corporate strategy. We operate the position, and indeed we operate most of the wells, so we control our expenditure, and the asset produces net free cash flow. That pays for our overheads, it pays for our short-term capital requirements, and from our perspective, we're effectively funded out of existing revenue. The company also holds a large acreage position onshore in Portugal. We have a gas discovery there. Again, we have a contingent allocation of resource there at around about 460 BCF of gas. And although geographically separated, it does broadly fit our strategy. We have always been and remain fiscally prudent. We have about $20 million US in cash. We live within our means. We expect to be at that point at year end, and indeed going forward as we plan out our corporate plans into 2018 and 19, we expect to stay there as well. A real quick corporate snapshot. Today, our market cap sits at around about $165 million. You can see on the pie chart there, we've had very strong institutional support out of Australia. And it's worth pointing out that management and the directors have put significant capital in themselves, around about $11 million to date. And that's been done at the same time and at the same price as many of our investors. So let's very briefly talk about the TMS and explain how Australis managed to pick up the position that it did. The TMS depositionally is very similar to the large Eagleford Shale. It's a shallow marine deposition. The Eagleford Shale is down in South Texas, and it's where Aurora held its acreage. The play was initially explored through 2010 to 2012. That's about a year or two behind the Eagleford. It followed a similar path as many of these plays did. There was initial land grab by many of the large US independents and names that you'd recognize. And those early entrants into the play drilled a number of wells to start to delineate out the acreage. The early wells showed a wide range of performance. Indeed, they showed large parts of the play didn't actually work from an economic perspective. As such, those participants tended to exit. Early wells were also relatively expensive. Of course, on a comparative basis, this play was just getting started, while others were now getting into full running and full steam. And as such, on a comparative basis, people could put money to work in other plays. And so the TMS started to develop a relatively poor reputation. However, some of the wells were prolific. We had strong productivity, high pressure, and a high oil content, which is obviously all important. For those that effectively stayed with the play and carried on drilling, and there have been about 80 wells drilled in the play to date, they actually delineated out a core acreage within which the results were consistent, and it's the red oval you see as a subset of the TMS on the map there. So, unfortunately, for those that did stay the course and stay with the play, in 2014, just as it was reaching an economic turnover point and activity was starting to pick up, obviously the oil price dropped. The reason it switched to an economic prospect was simply that some of the engineering problems that had led to the high drilling costs were starting to be addressed by the participants. Of course, as the oil price dropped, unfortunately many of the participants who did own acreage within the core of the play were highly leveraged. Many of them went through bankruptcy during the downturn, and this is a real example, I guess, of the right companies having the wrong acreage and the wrong companies actually having the better acreage. It's worth pointing out that not a single well has been drilled in this play since 2014, so none of the improvements that have come about from the industry have ever been applied to this particular play. Of course, that's our opportunity. We're now looking to take advantage of the nearly $1 billion that have been spent in this play. If we focus down into the core area, we've done two acquisitions. They're in in blue and yellow on this particular view graph. We secured our position on a highly consolidated basis, and we stayed very focused within that core area. The reserve and resource position is in the table on the left-hand side, and again, it's worth noting that over a quarter of our acreage is actually HBP'd. If we look at the wells that one of the vendors in Ghana drilled during 2014, and we average their production achieved on the wells drilled at the end of activity within the play, then we generate what we believe to be what we call a type curve, or an anticipated well performance. The chart on this particular view graph then shows the NPV return based on that well performance, and then looking at a variety of different oil prices and a variety of different well costs. Australis has constructed its own well cost. We've gone out to the market and we believe we'll drill a well today comfortably at $11 million. It's worth pointing out that's 25% higher than other participants in the play, and that generates the range we show here from $9 to $11 million. We sell our crude on a Louisiana light sweet marker. That's trades at a premium to WTI, and it closed actually at just shy of $60 on Friday of last week. So a $60 oil price and an $11 million well cost on the chart here, you can see each location generates an NPV of between $4.5 and $5.6 million. I mentioned earlier on, Australis conservatively runs 290 net locations within its acreage. So the assets that the company holds, we've acquired on a highly accretive basis. We took advantage of a set of circumstances. The company's remained technically focused and disciplined in our approach, and we now think we've generated a platform for significant shareholder growth with multiple catalysts. They include lower well costs, they include more wells, greater density, we're being very conservative in our approach, and better productivity. These are all traits and trends that you see within any unconventional field as it evolves and gets developed. Of course, we have the other catalyst that comes to bear in these plays as well, which is oil price, and we heard plenty of discussion of that before. So what's our plan? In the short term, we'll look to utilize our existing cash flow and consolidate our position, and we're going through an active leasing program to extend the lease life and to change the commercial terms. Once we've secured that, we'll use our land as currency, and we'll bring in an industry or a financial partner to help fund early activity, and we're looking to demonstrate both costs and productivity that's been achieved historically, but not been well known and made known to the public. Our intention here is to lift the value of the overall play, but most importantly, the value of the undeveloped resource that we hold at present. We do have a second asset, which is in Portugal, and just very briefly, this asset has a gas discovery. We've got 650,000 net acres that sits onshore in the Lusitanian Basin. We've had that independently verified as 460 BCF of gas, and that 460 BCF of gas is independently verified and as a result of 3D seismic. So 10 minutes never seems like very long. So in conclusion, if I could, just briefly, we've implemented a plan here that has been tailored effectively to the market we find ourselves in and the skill sets that we have. We're very pleased in terms of the progress that we've made, and we're very excited about the opportunities that are in front of us. I'd like to thank you for the very brief introduction, and of course we have a booth around the corner. We'll be happy to have any further conversations if you're interested. Thank you very much.